Welcome to the Bankless by Design podcast, where we rethink money, ditch the system, and rediscover what it means to truly thrive well. I'm Tricia Miller, mom of 7, financial coach, and founder of Thrivewell. Around here, we believe wealth is more than numbers. It's about freedom, stewardship, and building a legacy that lasts. If you're ready to challenge the norm and take back control of your financial life, you're in the right place. Hello, and welcome to the podcast. Thank you so much for listening. I really appreciate it. And today I want to talk with you about the differences between whole life insurance and term insurance. And I know there is a lot of controversy on social media about how one is better than the other. But right now, I just simply want to walk you through the features and characteristics of each type, considering the pros and the cons, and the purposes for each one. And I believe that by doing that, in the end, you will be better able to make an informed decision for yourself. So let's first talk about term insurance. So term is just that. It is insurance for a term. It is temporary insurance, and it will usually be sold in 10, 20, or 30-year terms. And term insurance then, if you will, is just a little bit like renting a house instead of owning one. So for a time, you sign a lease and you get to move in and you have a roof over your head. You're covered, so to speak. And you might need to do that until you can afford to save up enough for a down payment to go and purchase a home. So term insurance is a little bit like that. It is temporary. Now, the pro to term insurance is that it is inexpensive. You can usually get anywhere from $500,000 to $1 million worth of coverage for as little as maybe $30 or $50 a month, depending on your age and your health. And so certainly that is very affordable. The con to term insurance is that it is temporary, and 99% of the time, that death benefit is never paid out. So it's really about perhaps a tragic accident when you're younger or something like that. But it is needed, right? We need that coverage for our families. So especially perhaps a younger family that maybe has a lot of expenses, and right now being able to do something more is just not possible, but you really need that coverage. But there are some things that I think people need to know that are often not understood or even considered. So I want to talk to you about that a little bit. And that is, there are limits to what you can buy down the road in certain ages in life. So for example, you're not going to be able to buy a 20-year term life insurance policy or even a 30-year term life insurance policy after the age of 65. And that's because it is going to expire by the time you're 85. So this is something to consider because people are living longer. And if you believe that you're going to live beyond the age of 85 and you're interested in making sure that your spouse or your family still receives something when you pass away, then you're going to want to think about something besides term insurance. And oftentimes people will purchase a term policy when they're younger, say in their late 20s or maybe their 30s. And they think that they're covered for a certain amount of insurance. And then later on in life, they realize that they really need more insurance because their income has gone up. They have more assets that they want to protect and so forth. And unfortunately, that means that they're going to have to go back through underwriting. Now, we must understand that all life insurance is medically and financially underwritten. So this means that once again, you're going to have to go through a medical exam, and we don't have a guarantee on our health. So if our health has taken a turn for the worse and we are older, you can expect for that new term policy to be much more expensive. And one of the things that I feel like people don't realize is that if your condition is such that it is serious enough, you can even wind up being uninsurable altogether. And then that becomes a really sad and even devastating situation for people because they can't protect their families like they wanted to. So these are things that we need to take into consideration when we're looking at purchasing term insurance. Now, let me just share with you a real life example of this because just a month or so ago when my air conditioning unit went out in my house and I called my HVAC repairman over. We ended up having a conversation in the backyard about this very thing. And he had had a term policy that he was paying into. So he had paid premiums inexpensive for many, many years. And suddenly he's 86 years old and his next monthly premium bill that comes in the mail, he told me was $1,700 per month. He looked at me and he was like, there is no way I can afford that. And it wouldn't even make sense to do so. And unfortunately, this gentleman is just one of those examples where he didn't realize that he wasn't going to be able to afford to keep that policy any further. And he really was hoping to leave something in case something happens to him for his wife to live on beyond Social Security and the little bit of savings that they had. So this is a very real circumstance that happens to people. And so I think it's important that when we are all about buy term and invest the difference, and we hear all of these things on social media, that we're not taking into account the whole picture. And we need to understand these things so that we can make educated choices. Okay, let's now turn our attention to whole life insurance. Whole life insurance is also called permanent insurance, and that's because it is permanent and it lasts your whole life. It doesn't matter your age as long as it is in force and you have paid the agreed upon premium. And that premium does not change. That premium is level. But the reason it is more expensive, of course, is that term insurance is something that was for a term. And so if you think about it, the life insurance companies, they know that they're not bearing a lot of risk with that because most of the time, the term insurance policy is going to expire before you do. So they're carrying very little risk with a term policy. As I mentioned, 99% of them don't pay out a death benefit. But when it comes to whole life, it is necessarily going to be more expensive because they know they're going to pay out that death claim and they have to be prepared for that. So therefore, the premiums are more expensive, but they are also level across your whole life. Whereas the term, once that term drops off, if you wanted it, it would escalate exponentially expensive because the closer you get to death, obviously, the more expensive the insurance. And you had paid such a low premium before, now they're going to make up for it with a very high premium. So this whole idea of which one is more expensive and cheaper and all of that is a little bit of a misnomer because cumulatively, you actually wind up, and I've looked at the cumulative premiums on a term policy. If you were to try to keep it, for example, my gentleman who is 86 years old and looking at his premium, if you were to keep that and keep paying that through the course of, say, to age 90 or 95 when you're likely to pass, you would be paying far more cumulative premium over time for the term policy than you actually are for the whole life policy because they have spread it out, again, for your whole life. Okay, so the premiums are level, but over time, one of the other things about whole life is that the death benefit continues to increase. So in some senses, as I mentioned before with the term, when you get a little older and you realize that you need more insurance, with whole life, that death benefit is likely to keep up a little bit better with your insurance needs because the death benefit is continually increasing every time you pay a new premium. And whole life is also a little bit more like owning your property instead of renting because when you're renting, you do not have an equity interest in the property, right? But when you own a property, you do grow some equity in the home as the home appreciates, mortgage pay down, you got some equity growing inside of your home. But it is similar because inside the policy, you are growing equity and that equity is known as cash value over time. And this can act like a savings account while also at the same time, those dollars are protecting your family. So it helps you understand why this is happening when you understand that the cash value by contract with the life insurance company must rise to meet the death benefit by age 121. And I know people say, well, I'm not going to ever live to 121. That's not the point. The point is that actuarially, the cash value must equal that death benefit by that age. It used to be 100, but obviously we are all living longer, so that has changed. But what that does, though, is that it forces an increase in the cash value every single day. As you age, that cash value is going to rise. That means that you have an ever increasing pool of cash value inside the policy. And here's the thing. You can use it for anything you want. You can use it to go buy a car. You can pay for tuition. You can take a family vacation. You could put a down payment on a house. Heck, if you've got enough cash value in there, you can buy the whole house and create your own sort of in-house mortgage. But better yet, a down payment on a rental property that would create a new income stream. So if you're smart with it, there are things that you could do with this cash value by having access to capital that you own and control, that no one can tell you that you cannot access this capital. I highly recommend people borrow against that so that they're actually using the life insurance company's money. But there are ways you can withdraw it as well. They may have more tax consequences in that regard, which is why we recommend leveraging it and borrowing against it. But just the same, the point is that this is a living benefit of whole life that you don't have with term insurance. So think for a minute what you might be able to do if you had access to capital. And I would highly recommend that you don't just take that capital and just go spend it and then never pay it back or treat it foolishly. You do need to be wise about that. But let me give you an example. Walt Disney, many, many years ago, when he first had his ideas about Disney World, he went to the bank to try to borrow the money to start his business. And they laughed at him and they were not interested. They did not think it was a good idea. So they refused to lend him any money. But as many people did back in the day, he had a whole life insurance policy that had cash value that he could access. So he borrowed from his own policy and started Disney World. And so you see, when you have access to capital and you're very wise about the use of that capital, I don't think you're going to care what the premiums are anymore. I don't think Walt Disney did. The other thing about whole life insurance is that it pays dividends. When you're participating with a mutually owned life insurance company, at least, you get to share in the profits of the company. And over time, those dividends can become substantial. And you can take them as cash. You can use them to reduce the premium. You can even pay your whole premium if you want to. Or as I recommend for the infinite banking concept especially, it is better to let those dividends purchase more paid up additional insurance, which of course drives the death benefit higher and the cash values have to rise and chase that death benefit. So therefore, we are exponentially increasing that pool of cash value that we can use to take over the banking function in our own lives. I also want to just emphasize that whole life insurance is actually an asset. If you wanted to, I don't recommend it, but you could take it down to the bank and collateralize a loan against that because the bank recognizes it as an asset. You cannot do that with your 401k because there's risk involved, but the bank knows that that whole life insurance policy is an asset. And I would even call it a cash flowing asset because there's going to come a time when you can access more capital inside that cash value than you ever put into it. In fact, depending on how long you've owned it and what you've done with those dividends and different things, it can end up being multiple times the amount of premium you've ever put into it. And therefore, it means that every single penny you've ever used to pay premium, you could get back and more. So while it may appear on the surface to be more expensive up front, or require a little bit more of out-of-pocket cost, in the long run, it really can pay for itself. So let's remind ourselves the purpose then of whole life. Whole life is permanent coverage that you cannot outlive with living benefits too, such as that pool of capital. It is really great for legacy-minded people because they're going to be able to leave something for future generations, no matter their age. And it's for people who maybe want and know how to use that capital that is sitting inside that policy in a tax-advantaged and penalty-free way and to be in control of their financing needs. So term is cheaper up front, but it's temporary and it does have a purpose. But remember that it is a temporary purpose. And 99% of the time, it doesn't pay out the death benefit. So this just leads me to this idea that cheaper does not always mean better. And yet we have been sold this idea that cheaper is better, and yet cheaper is not equated with value. So the old saying, you get what you pay for, more or less really rings true here. So just keep this in mind as you're hearing all the pundits out there excoriating whole life and saying, oh, the only thing that you should do is buy term and invest the difference. And I guess as long as I just made that statement, I want to say, my question is for those of you who have decided to buy term and invest the difference, are you really investing the difference? And when you do, of course, you are putting that money at risk. Whereas with whole life insurance, you have a growing pool of capital that is guaranteed by contract, never to be at risk. So it's an interesting conversation. I don't want to totally get into that controversy, but I think it's important for us to understand that. Now, here's a sad reality that I did want to talk about here as well, and that is that only about half of Americans are actually insured with life insurance at all, and the vast majority of those people are far underinsured from what they should be. It is extremely rare to find someone who is properly and fully insured. And we prioritize things like car insurance and homeowners insurance because, of course, we do not want to have the loss of a vehicle or certainly not the loss of a home due to a fire. That would be devastating to our financial lives. And yet, so we prioritize those things and we make sure we have those things. And I know there are also laws about that because we usually have lenders behind it and all of that requires it of us. But we need to take a moment to think about this for a moment because we do put our dollars toward those risks, but they are risks that are possibilities. They may never even happen. And yet we prioritize that, but we don't insure ourselves, our own lives. And if we're honest with ourselves, we are our most important and most valuable asset. So why aren't we insuring ourselves? We have earning power that perhaps is needed in the family. And if that is lost, that too would be very devastating. And the reality is, it's not an if we're going to pass away one day, it's a when. So it is a sure thing. And yet we do not insure against it like we ought to in this country. And I guess I would also add that one of the things that we tend to do when we think about life insurance is we think about it in just terms such as, well, I need just enough to pay off the mortgage because then my family will be fine. Well, not necessarily so. There is a lot more to think about when it comes to how much insurance you should have. If you consider how much salary that you're making and that amount of salary for the next 30 or 40 years would suddenly disappear from your family's life, that's a significant amount that really should be covered. So let's consider for a second, what if your spouse were to die today? Do you really think that tomorrow morning you're just going to get up and go to work like normal and everything's going to just, within a couple of weeks, you'll just get over it and you'll be fine? No, that's not what happens. This is an event that upends an entire family. There might be children who are affected, who need counseling. Maybe they need education money in the future. They need money to purchase vehicles in the future. There is a lot going forward. Maybe your family just really needs some time to not have to work, some time to grieve. And maybe that looks like a family vacation together where you can come together and love on one another and take some time to figure out a new way of life going forward, because this is not just some small interruption in your daily lives. And so that's one of the things I love about really properly being insured. It allows you to do that. It allows you to grieve properly. Okay. Now, I know this isn't always a fun topic, but it's a very real thing and we need to think about this. Before I close, I want to share with you how I recommend people often use both term and whole life insurance. So, for example, if you are just starting out and you're not able to put forward the amount of premium needed to start a whole life insurance policy, then a fantastic thing that you can do is get yourself a convertible term policy. Now, convertible term is a little bit more expensive than regular term, but not a lot. We're talking a few dollars. And that's because it is convertible. But it allows you to have the death benefit coverage that you need while you're younger. And then down the road, when you're more capable, you can convert part or all of that convertible term into a whole life insurance policy. And now you are covered for your whole life. So it allows kind of the best of both worlds because you can have that affordability up front, and then you can pay the higher premiums later on and have the coverage that you need for your whole life. And the real key thing here is that once you have that convertible term, you no longer have to go back through underwriting. So even if your health were to take a turn for the worse, you're covered. You can convert that to whole life with no further medical exam, and you are good to go. So this is where I think we have a lack of understanding of the amazing things that we can actually do with both term and whole life. Also, when practicing the infinite banking concept, there's a little bit of a misnomer that I want to clear up, and that is that IBC is all about whole life insurance only. Well, even the design of a policy for the infinite banking concept, for the practice of performing your own banking, is designed with a term rider on top of the whole life insurance policy. And oftentimes, because of the way we design it for a higher early cash value, then the death benefit is lower than what an individual actually needs to have for their insurance needs to be covered. So therefore, I'm often, depending on what other insurance someone might have, I'm recommending a convertible term right alongside that whole life policy so that they have the proper death benefit coverage while they have another policy to perform the function of banking. And then as they get older and finances improve and they make more income and all of that, they're able to convert even more of that term and expand their system to another whole life insurance policy, because that is what Nelson talked about as being a system of policies, not just a single one to become your own banker. So that's just a little bit of how this works with the infinite banking concept. But the major point of this whole episode that I really wanted to do was to recognize that every person's situation is different and your needs are different depending. Do you own a business? Do you have partners that should be insured with you? Are you an entrepreneur? Are you a W-2 employee? Do you have family? All of these different things and your goals, your needs, your income factors, your health situation, all of that can affect what kind of insurance is best for your situation. So it isn't something that should be decided based on a radio talk show host or a financial entertainer. This is a serious matter, and your family's future is at stake. And it's very possible that you need just a term insurance in the beginning, or you might need convertible term and a whole life insurance policy, or a little bit of both. They are not to be pitted against each other. They are different products for a different purpose, and they both serve their purposes well. So I hope that this helps you realize that there's so much more to this than these little sound bites that we get out there on the internet and in social media. It's so important to really be educated and understand and speak with a professional who can evaluate your circumstances and design something that works to meet your needs going into the future. So if you found this helpful and you need some life insurance, I would be happy to take a look at your situation and help you with that. And if you're interested in the infinite banking concept, of course, I would love to have you reach out to me. If you reach out to me, we're going to take a look at all of your circumstances, your income factors, your health situation, the people that you need to protect. And we're going to design something that is suitable for your situation going forward. I hope you found this helpful, educational, and if you want to reach out to me, please don't hesitate. You can find me at banklessbydesign.com, or you can even email me at tricia@banklessbydesign.com. Meanwhile, if you found this episode helpful, I would love it if you'd give it a like, share it with somebody who needs it, leave me a comment. I'd be more than happy to respond. And until next time, you have a great week. Thank you so much. Thanks for tuning in to the Bankless by Design podcast, where we're done with the system and we're doing money differently. Be sure to subscribe, share this episode with someone who needs it, and visit us at banklessbydesign.com to learn how you can start living bankless by design.